Have you taken a hit on your crypto investments this year? Maybe invested in a meme coin that went to zero, possibly got rug pulled? Don't worry, I've been there too. Reporting your crypto losses can actually save you money on your taxes. So stick around to learn how you can turn your losses into tax deductions. Hey there, crypto fans. My name is Eric Neum. I run an accounting firm that does full service accounting and tax work for cryptocurrency-based businesses and investors just like you. And I am here to make complex financial topics sound easy and also hopefully fun. Today, we're diving into the nitty-gritty of reporting crypto losses on your taxes. Now, it might not sound thrilling, unfortunately, because of the losses also, but trust me, maximizing your deductions is a game changer. Let's get started. Now, cryptocurrency is a roller coaster, and sometimes, unfortunately, we end up in the red. But here's the silver lining. These losses can actually work in your favor when it comes to taxes. I'm going to show you how to report your crypto losses correctly, maximize your deductions, and therefore make the most out of a less than ideal situation. First of all, let's clarify what constitutes as a loss. A loss occurs when you sell or trade your cryptocurrency for less than what you paid for it. For example, let's say you bought Bitcoin for $50,000 and then you sold it for $30,000. That means you incurred a $20,000 loss. Now, if you have a loss because of a bankruptcy filing like Celsius or FTX going under, or were a victim of a cryptocurrency scam, those are different topics that I'll cover in another video. So the first thing is, how do we report these losses? You're going to need to use IRS Form 8949, which details all of your sales and your trades, and then summarize that and push it onto the Schedule D. This form summarizes your total capital gains and losses. So here's a bit of a step-by-step of how I like to do this. The step number one is you want to gather all of your records. Collect all of your transaction records from your exchanges and wallets. Platforms like Coinbase, Binance, and Kraken provide detailed transaction histories that you could download. Personally, I like using a software like Coinly or Cointracking to download all the transaction history into one unified platform to quickly sort through your gains and losses, because it can get overwhelming. If you have a high volume of trades, like over 500 trades for the year, I highly recommend using a service that's like a professional accounting service just like us to handle processing all of your trades and determining your capital gain. Okay, step number two. Now that you've gotten the data and you've sorted through it, you're going to fill out tax form 8949. You're going to enter each transaction separately. You're going to notate the date you acquired the cryptocurrency, the date you sold it or traded it, the amount you paid, and how much you received. This form helps the IRS see exactly how we calculated your gains and your losses. And then you use Schedule D. This is step three. You take that information and you put it onto your Schedule D. This form totals up all of your capital gains and losses. Now, you could always subtract your total losses from your gains to reduce your tax. Now, if your losses exceeds the gains you had for the year, you could use $3,000 up to $3,000 of those losses to reduce your other taxable income. Any additional losses that you have for that year can be pushed forward to future years, but it's important to document it. Let's give a real-world example. In the real world, back in 2021, many crypto investors faced a ton of losses. I did as well. One notable case is that of many early Dogecoin investors that bought at the peak, at the Pico top or the peak height. A lot of them ended up selling at lower prices, which incurred substantial losses. By reporting these losses correctly, they were able to offset gains from other investments and reduce their taxable income. Because cryptocurrency is treated as property by the IRS, keep in mind, there's also no wash sale rule either. This means that you could sell an asset to capture the loss so that we could write off in your taxes, but then rebuy that asset again for long-term holding, which is a really unique tax strategy. But wait, there's more. Did you know that you can also claim losses from lost or stolen crypto? If you've fallen victim to a hack or a scam, these losses can be reported as well, although the process is slightly different and requires a bit of additional documentation. I like to mention that tax softwares like CoinTracker and CryptoTrader.tax can automate and simplify the process, making it easier for you to report accurately and ensure you're maximizing your deductions. If you found this video helpful, make sure to give it a thumbs up and subscribe for more crypto content. content. Don't forget to hit the bell icon so you can never miss an update. Do you have any questions about reporting crypto losses or about your crypto taxes? Drop them into the comment section below and I'll be sure to answer them. Let's turn those losses into wins. Now, if you're in need of crypto tax assistance or filing, please feel free to reach out. I'll put a link in the description. We work with clients all around the US, both on the corporate side and on the individual investor side. Thanks for watching, and remember, knowledge is power when it comes to taxes and crypto. Stay informed, stay savvy. Until next time, happy trading.